welcome to the Monday Futures Market Outlook for June 17th, 2013. This is Patrick Serezna. As always, we start off with a chart of the US dollar index futures, and this has probably been the most significant currency move that we have seen this year. We had a very distinct US dollar uptrend driven by a weakening euro and a substantial downtrend in the yen and the British pound. We've now seen a very material reversal that in 1 month has undone almost all of the progress that the US dollar has made throughout the year. Now, that doesn't immediately expose the US dollar for much more further downside, as we may test maybe another dollar lower down toward the 80 or 79.50 area, but at some point we will get an oversold bounce. But if we see a scenario where the US dollar uptrend is no longer a viable thesis, at that moment that has substantial intermarket implications that we have to take into account for movement of currency and commodities. Next year, when we take a look at the euro, we've seen a substantial rally higher. One of the reasons why the US dollar had such a material reversal down, and this is primarily being driven by Draghi's reluctance to join into the substantial monetary easing policies that Japan and the US have undertaken. This certainly is significant of a move. We see some short-term overhead resistance around this 133.50, 134 zone on the upside, which at this juncture could create the space where we have a 100 to 200 pip euro throwback on the downside. But at the same time here, if this has begun a new trend where the euro may strengthen back to the year highs around 137, that certainly does have substantial implications on the US dollar and subsequently the trend again of those commodities, which we're going to be analyzing in a moment. Next year, I want to take a look at the 30-year Treasury bond, and we had a substantial price move that has really taken off the table an immediate uptrend. Now, obviously, when Ben Bernanke speaks on Wednesday, it would certainly have a direct impact on a potential new trend. But the fact that we've completely wiped out all progress that was made in the month of March into April, certainly at this moment, at minimum, puts a neutral stance on this. Now, there's two schools of thought here. Number one, you can adapt the bond bearer theory, where there's where people are anticipating a very material correction and subsequently a spike in interest rates. But at the same time, that would be quite counterproductive to the economic progress that the U.S. has been making. In fact, the further intervention in the bond markets and maintaining lower interest rates makes a lot of sense on a much bigger perspective. So really, at this stage, we're not going to buy into that bear camp of bonds, but not necessarily bullish either. I mean, we are quite oversold on this bond, and seeing the 30-year trade back to 142 to 143 handle on the upside is certainly something that it will inevitably occur, but whether that leads to another round of selling is something that we'll have to explore after we see where the oversold bounce finds overhead resistance. Next year, we're going to take a look at copper futures. First observation we want to make is there's a tendency that when the U.S. dollar weakens, that it allows commodities to at least benefit to one degree or another from that U.S. dollar weakness. Now, we haven't seen any positive price action coming from copper yet, but certainly with the U.S. dollar remains down at these lower levels, that it certainly will put in a chance that copper could put in a bottom along these levels. While we were substantially bearish copper to even anticipating a move down to 275, really at this stage, if the US dollar has reversed, then the downside risk becomes diminished. If we see that the copper makes a higher low here, then there's room for copper to potentially swing back up to even 345 or 350 on the upside and even break to a higher high. So let's watch to see whether or not copper can catch a bid down here. Next year, when we take a look at crude oil, we have a similar situation where crude oil has been allowed to strengthen as the U.S. dollar has weakened. This breakout to $98 while it's approaching our first target zone on the upside at focal point around the 99-100 level. There is room for even a rally as high as those September highs of last year, around 102. So there is definitely some room for a little further oil strength. When we get up to those zones, we'll be watching how the price action behaves and see whether or not there's room for even further strength in oil from there. That's just simply the first upside targets that we'd have for crude in this environment. Next year, I want to take a look at gold, and gold futures are continue to consolidate down near the lows. We've in the past speculated about double bottoms, but clearly the price action is not supporting an upside reversal, and therefore it's not very valid of observation at this juncture. At this moment, we do have to, though, observe that 1350 support line and watch to see whether gold can contain this. If we do see that gold does not break below this to lower lows, then there's room for it to still reverse and push higher. But we do want to emphasize that the measured move on the downside of gold does measure out even below 1300, even as low as 1200, and so if there was any substantial price breakdown from these kind of levels, it really can open the floodgate for a new round of selling to get engaged. And so it's very important that the gold bulls really support this the prices here and create some positive price action in the upcoming weeks. Finally, I want to take a look at the S&P 500, and when we observe the chart here, we've had a correction now that's been going on for well over 3 weeks, and it has been about a 5% pullback. So a lot of this has started to meet the minimum requirements of market corrections. But then we really have now the Fed event coming up on Wednesday, which really will act like a psychological anchor to feed the bulls or the bears. And so really this is the bottoms that we've put in around the 1600 level are really going to give some very valuable information in the as we see the reactions on Wednesday. If those are the lows that end up holding this consolidation and the bulls are able to continue to follow through on the upside, then we have room not only for a full retest of that 1680 level on the upside, but that we certainly can't even rule out a stab at 1700 if there was an attempt for that. Now, we do believe in the bigger picture that the market has already finished its move, so any stab higher on the market here is probably going to lead to substantial distribution, but topping formations tend to do this where they correct down, come back, retest those highs, get redistributed along there. We're not looking for a new robust leg of a bull market, even if these lows do hold, but that certainly does if the Fed reaction is positive and we see price action getting to 1650, 1660. At that moment, we have to acknowledge that then we have to wait for new signals for a new down leg for there to be a real engagement to the downside. At the same regard, if the news is interpreted in any way negatively and we see break to lower lows, which is where about the 50-day moving average lays as well, a breakdown below 1600 for any sustained period would really open a floodgate for the selling to really intensify. And so really it's not hard at this moment for investors and traders to have a very neutral stance. In the end, below 1600 you're bearish, and so long as price action holds here, you can look for short-term strength, and then we'll see how the market develops into the end of June. Just to make some key intermarket observations, it's hard to see the markets at any real extreme points. Now, bonds and the US dollar are quite oversold on the short term and certainly have room for a bounce. If they both fail to make higher highs or retest the high end of the zones, we will change that to a poor risk-reward proposition on those failed rallies to indicate that another round of weakness may occur. In the same regard with commodities, while while it has a very distinct downtrend, we don't want to yet be quickly putting commodities on a buy signals other than crude oil, which has given that good signal. A lot of the other commodities have yet to really give us an indication that a bigger picture uptrend. So if you wanted to take the strongest commodity market, certainly would be crude at this juncture from our observations. The stock market, no matter what, whether or not we're going still back to retest the highs or not, we still view U.S. stocks to be a poor proposition. Now, global stocks, on the other hand, have been poor, and they have actually been breaking to lower lows. We've seen new downtrends beginning, including the Nikkei having a full 20% correction. We're actually seeing far more oversold global markets, which may actually emerge as a buying opportunity sooner than the U.S. stocks, which have yet to have any real meaningful market corrections on the downside. So we're going to be observing what's going on there. But certainly many of you can observe these global stocks and see where bottoms start developing in a lot of those international indices. That was your Monday Futures Market Outlook. Thank you for joining me.